All right. I don't know if this is streaming, but we'll see. I have to reload all my YouTube. YouTube is crazy. Just absurd. But we are like a couple of minutes away from the actual release, huh? So let's see. YouTube is telling me I'm live over here now, which was refusing to work. But whatever. Yeah, I don't know what happened, ladies and germs. I'm sure you'll figure it out because there's nothing I can do to help. Sorry, this is all YouTube. This ain't me. But anyway, so what I was saying, if you were on the other live stream, which was the erroneous live stream, and I think this is now the correct live stream. What I was saying is, if we're tracking the 2-year Treasury and the 10-year Treasury, we can track the spread between the 2 and the 10. I can track the spread between the 3 and the 10, which I know is actually not reported on, but statistically is a better measure of the actual economy and investment institutional sentiment. But for most people, reality doesn't matter. They want to talk about the 210 because that's what people talk about, even though it's not actually the most accurate. So now we can do both as well as the 1 month, right? We have the 1 month and we have the 3 month. We have the 2-year, we have the 5-year, we have the 10-year, and we have the 30-year. Now you know it's all over the place. Well, this is organized, I think. By bullish and bearishness. If not, I'll have it reorganized. But at least it very clearly tells you bullish or bearish, huh? Okay. So like I said, when you look at gold, it's the net position, okay, which is bullish trade minus bearish trades or long positions minus short positions. And then you see there's 50% more longs than there are bears. The market isn't at equilibrium. There's 50% more bulls than there are bears. So it's very bullish. Now you're like, well, Wayne, how do I keep up with all that? We actually have a key down here. It explains all our methodology. So this is the secret sauce, okay? And the goal here is not to have some proprietary data that makes better decisions than you, and you'll have to pay me money to get the answer. I'm trying to give you the information you need to make an informed decision, and I want to give you the calculations to the answer. I want to teach you how to trade. And so I'll give you the answer. Well, and real rates are tied to inflation and all that kind of stuff, right? So, anyways, look at all this amazing data. And you're like, Wayne, that's just too much data. I can't read all of that. Well, so what are you, a Forex trader? Oh, I'm a Forex trader. Right. We're at Forex.Today, right? Oh, well, why don't you just look at the 8 currencies: the CAD, the Kiwi, the Aussie, the Swissy, the dollar, the yen, the euro, and the pound? Look at the market. So the pound, okay, the CAD is very, 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 very bearish, right? Here's the week over the week change, but check this out. Now it's organized just the assets that we're looking at. And then what it does is it looks and says, well, of these, combine the most bullish and bearish of the assets to say, hey, you should look at CAD yen, in this case down, right? You should look at Euro CAD. You should look at Kiwi yen. You should look at Aussie yen. You should look at pound CAD. You should look at Euro Kiwi. Isn't that amazing? So we got a Fed decision coming out. Let me pull it up. Where is it? For some reason, there. That's the press conference. So we got the press conference. That's not for another 30 minutes. So go ahead and mute that. And if you get the answer, I accidentally broke our squawk box, so I'll fix that later this afternoon. If you got the answer, let me know. Okay. They're expected to cut. I don't even really care about that. I care about other things, in fact. One of the things I care a lot about is quantitative tightening. So we got our statement here, pulling it up. Here it is. Let me pull it over to the correct monitor. The committee decided to lower the target range for the federal funds reserve, uh, federal funds rate by the quarter point. Yay. Okay. So 3.75 to 4.0. Now, we already knew that. What we care about is the change in quantitative tightening. Considering the additional adjustments to the target range for the federal funds rate, the committee will carefully assess income data, involving outlook, and the balance of risk, which they can't measure any of this because we don't have any data. Aha! The committee decided to conclude the reduction of its aggregate security holding on December 1st. So, starting on December 1st, quantitative tightening dies. And my guess here, even though what assets they're reducing from their balance sheet up to then, my guess is that they're going to try to get rid of their mortgage-backed security, make that a priority. What do you guys? Yeah. So that's a big deal. That was the thing that I cared about. I expected as much. I thought they could just say that they were going to slow the pace. But in this case, they stopped quantitative tightening, not instantly, but basically by the end of the year. So what does it mean? Well, in the past, when the Fed cut, they were also reducing their balance sheet. Because remember, the Fed bought $5 trillion in assets during COVID. So they've sold a few trillion of them back. Well, when they sell a bond, okay, a treasury on their balance sheet, they sell it to like JP Morgan, which means they take money away from JP Morgan, or to say it the other way, JP Morgan gave money to the Fed and the Fed gave them that bond. So now the Fed has taken money out of the market, which is reducing the money supply, which is has the same effect as raising interest rates. So, one way to look at what just occurred is it's a double cut. It's a cut in the policy of raising interest rates through quantitative tightening. So they're still doing it, but they're going to end it. And then the second thing is they've cut the Fed funds rate, which changes interest on reserves. It changes repo rates. It changes the discount window. That's why we have a range. No other central bank has a range. This 3.75% to 4%. It's because the Fed doesn't do what other central banks do anymore. And I'll be teaching you this soon. I just attended a Fed meeting 6 days ago, and I think I have one coming up maybe tomorrow. So I'm hanging out at the St. Louis Fed all the time. Yeah, it's cool. So I'll teach you why this works. Also, when it comes down to the politics, who's going to replace Jerome Powell? You got Waller, you got what's her face, and then the others. Is it Bowman that's going? Probably Bowman. You got Waller, and they both want to like radically slash and burn interest rates. All right, so they want the job, and that's what you have to say to the president of the United States to get the job. Okay, great. So is there a difference besides that? Yeah, one of them wants to kill this new process that the Fed's been using for several years now that I'm going to teach you, right? Using floors. Okay, so think of it. 3.75, 3.75% is a floor, and 4% is a ceiling. And the effective rate is somewhere between the two. You see? And one of them says, Mr. President, not only will I slash and burn interest rates, I'm gonna end ample reserves. I'm gonna end the floor and ceiling methodology. And we go back to what we used to do, which means I'm going to teach you what we're doing now, and then we'll go back to, yeah, but whatever. Who knows? That's all politics, right? But it's going on in the background. I hope you know that. So if you understand monetary policy and central banking, if you're managing billions of dollars as a asset manager, you're a big shot on Wall Street. These are the things that you're actually thinking about. Well, who's going to get it, Waller or Bowman, and what's the difference between the two? What's their monetary policy? But what framework are they going to use? Oh, good to know. Okay, good to know. So, anyways, that's that. So the big thing is, holy smokes, quantitative easing is going to end by the end of the year, and that is equal to cutting interest rates. So, in a weird way, this sets us up for no cut in December, but an end of QT instead. Ha 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 ha! Oh, you might not have gotten that on CNBC today. They just told you we cut today, and we're going to stop QT, but we're not going to stop it till right before the December Fed meeting on what, the 11th? December 11th, December 12th. So, well, hell's bells. So they can say, well, due to the government shutdown and the lack of data, we've decided to just pause and see what we see. And meanwhile, we ended quantitative tightening, which is the same as government. So cool, right? Now we're smart. Please. Oh, share the link. You just go to the Fed. You don't You don't go to the Federal Reserve website? Oh my God, I go like 8 times a day. But there you go. Make a mash. Yeah. So, anyways, neat, right? So, one of the sites that it's interesting. My browser sessions are all. It's not pulling it up on me. This is a government agency. It's actually a database part of the St. Louis Fed. My favorite Fed, by the way. These are the guys I meet with often. So again, I met with uh, the leaders of the St. Louis Fed last Thursday, and I think I got another meeting with them tomorrow. So I meet with these guys probably 6 times a year. Uh, I've visited once to take a class, and I visited again and taught a class. It's kind of a highlight of the Wayne, something that I'm proud of. I taught a class at the St. Louis Fed, and the audience were university professors of economics. Like, dude, brutal, brutal. Get up there on the podium, teach these tenured professors how to teach economics. Yeah. So, anyways, the Fred, and I got to meet these guys. The Fred is a database, the Federal Reserve Economic Database. Cool. And so now you have a bunch of macroeconomic quantitative developers that build this massive database. And it's crazy good, right? But check this out. If you go to GDP, you're like, oh, well, Wayne, it's easy, right? You just go to GDP and it'll tell you GDP. Cool. Now what do you do? 74,408 GDP databases.